Another instance of severance from employment, which the regulations describe in depth, is where an individual no longer works in the capacity to engage in a 403B, but still works for the same employer. And the example of that is, let's assume someone worked for a state's educational institution where, by virtue of their educational background and their work with the educational institution on the state level, they went ahead and had a 403B and had participated in it. But they went and then moved to the state's Department of Transportation. They still work for the state, but they don't work for an organization that could offer 403B. In that instance, the individual would also experience a severance from employment for distribution purposes.
Bob, have the rules about in-service transfers changed?
Yes, in-service transfers were known as 90-24 transfers. And these type of transfers were in-service transfers, what they called annuity-to-annuity transfers that did not involve employer involvement.
Bob, you said annuity-to-annuity transfers. Does this apply to custodial accounts and church retirement income accounts?
Yes, Revenue Ruling 90-24 that dealt with in-service transfers applied not only to annuities, but also in the more encompassing term that annuities also refer to in the world of 403B, and that is custodial accounts and church retirement income accounts.
I understand that this provision had generated the greatest number of public comments received on the regulations when they were in proposed form.
Absolutely. What would happen is this, and why it generated so much interest. It was felt that this right to transfer was a very, very important right to participants, so they wouldn't be locked into an investment which they were not pleased with. But let me talk for a moment about what happened and how this unabridged right addled both the employer in compliance and the Internal Revenue Service in enforcement of the rules of 403B. What would happen is, and I'm going to give an example of an individual who worked for a tax-exempt organization which had 5 payroll slots for various vendors to offer benefits under 403B to their employee participants. However, one employee, for example, came to their employer and said, well, I know of the ABC custodial account which has better earnings than any of the ones you offer. I would like you to create a 6th payroll spot to accommodate what I would like to do in regard to my 403B investment. The people in charge of this said, no, we are not going to create a 6th slot. We are going to stay with 5. We can't be overburdened with sending monies to many different vendors. The individual under 90-24, Revenue Ruling 90-24 that is, was really then permitted to go ahead and take their accumulated benefit in the existing 403Bs, let's say they had $100,000, and they could transfer that amount somewhere to another vendor or even out there in cyberspace. They would transfer this amount to the vendor who they felt offered the best type of investment opportunities for their accrued 403B benefit. The problem with this was the transfer was not a reportable event on a 1099, so no one, especially the Internal Revenue Service, even knew it took place. And what would also happen is the employer, who would be charged with varying responsibilities in regard to the 403B, would not know where the money was either. How then could they deal with such things as are loan limits being exceeded? Is the financial hardship actually appropriate? Are individuals abiding by the varying distribution restrictions? This just wasn't working. So we proposed a new regimen, which I like to call Beyond 403B, that deals with in-service movement of funds. Remember, once a person has severed employment, they can receive a distribution under the rules of 403B, so that's not relevant for this type of movement of funds. This is a movement of funds that takes place by a person who is still working. And the regulations come up with two types of transfer regimes in the new world beyond 9024. The first deals with when the transfer takes place within the same plan itself. Now remember, this world is a plan-based world, which means that actions that are taken, the actions that are available under a plan, are actually set forth within the plan itself, and they must be followed in accordance with the terms of that plan. So, if you were to have movement within the same plan of funds between vendors, first of all, the plan would have to permit the movement. Second, the benefits could not be diminished. Third, when the funds move, those that were subject to distribution restrictions must be subject to the same distribution restrictions. They can't be diminished. And finally, the employer and the issuer must enter into an information sharing agreement so that the employer knows exactly where the funds are so that they could comply with the various aspects of the Internal Revenue Code. Now remember, we split 9024 into two new regimes. What I just discussed was the actual movement of funds within the same plan. But let's address for a moment a plan-to-plan movement of funds. The plans, again, would have to permit. The transferor plan would have to permit the movement out. The receiving or transferee plan would have to approve and permit for the acceptance of the funds. The participant would have to be an employee or former employee of the employer for the receiving plan. They could be a current employee or a former employee of the employer who has the receiving plan. And as before, the distribution restrictions cannot be diminished and the benefits cannot be diminished. So the new 9024 deals with two things: movement within the plan and movement between plans. And because we have written plans, the rules and the logistics of these movements of funds would be spelled out and outlined in the plans themselves.
How are church 403B plans affected?
Well, in a church environment, a 403B plan is known as a 403B9 retirement income account. It's a special type of 403B because, as I said earlier, 403Bs can only invest in annuities issued by insurance companies or in the stock of a regulated investment company. However, in a church 403B, not only can you invest in these annuities and these mutual funds, but in this retirement income account, you could also invest in any other type of investment that would be suitable for a qualified retirement plan. And in the retirement income account, the regulations tell us that, again, not only must you have a written plan, but the plan must state its intent to be considered a retirement income account within the meaning of 403B9 of the Internal Revenue Code. And unlike a general 403B, a retirement income account carries with it the rule that the amounts be held for the exclusive benefit of participants, what we call the exclusive benefit rule. This does not apply to general 403Bs, but it does to retirement income accounts.